Hello, this is Ifan from the Strategic Day Trader, and I have a special presentation for you today that I think will be pretty fun. I'm not going to get too chart heavy as far as technical analysis. We're going to talk about some of the common market sayings, common market wisdom that gets used a lot, but sometimes can seem like direct contradictions with each other. Okay, it's something that we've definitely talked about in the Strategic Day Trader room. But I wanted to kind of go over here and just use a couple examples from last week. Okay. All right. So I first want to let you know about the Turnaround Trader program that we just launched a couple weeks ago. All right. And so this course is meant to help you turn around your trading if you're struggling. You need work. It covers everything from strategies, entries, management, making sure that your trading plan is complete, that your daily routine is complete, that the system that you're working with, all right, is prepared and ready for each and every day. Okay, so there is a link in the description, okay, if you're interested in that. All right, so starting off, I get a lot of questions kind of daily just about kind of things not making sense in the market. I think we get that a lot, and I think contradictions are pretty common. So, some of these questions like, how come the stock is gapping down even though it had good earnings, right? And a lot of times the answer is that their forward earnings maybe not as positive as analysts would like, or generally traders and investors, right? Or they had greater expectations, even though the earnings were good, they were expected to be even better, right? There's kind of different things that cause the market to decide that stock should be sold, even though they have good earnings, right? And then why is the stock gapping up when they're laying people off, right? Shouldn't that be bad? It means the company isn't doing well, right? They're not hiring, they're actually reducing their workforce. And so a lot of times that's viewed by the market as they're cutting fat or becoming leaner, okay? And then this we see a lot of lately, especially, right? It's, some days if the market's down, you'll hear financial news media say that the trade war is really weighing on the market. And then other days when the market's up, oh, the market isn't that concerned or is optimistic about a resolution. Sometimes you'll see this narrative even flip within the day. That though, if the market is down and then becomes up, you'll see that same thing kind of flip. And so, that's just because they want to have a reason to explain the market movement, helps make more sense to people. And so you'll get stuff like that, right? So they need some kind of explanation. So those are kind of the common contradictions that I run into, very kind of simple. But I think the more complex ones and the ones that I really want to dig into are more about kind of the philosophy that we apply to our trading. So this one really applies to our management. Okay? So I'm sure you've heard both of these before. Let your winners run, cut your losses quickly, as well as bulls make money, bears make money, pigs get slaughtered. So if you take both of these to be true, you have a trade that's working. What do you do when the trade is profitable? Do you say, should I just let it run? Let it keep going? Or should I take it because I don't want to be too greedy? So at face value, these two things seem very much contradictory, right? But there is a way, right, and that's what I want to get into in this presentation, to have both be true, both be applied to your trading. Okay, so we're going to dig into these and we're going to look at some examples just from the previous week here. Okay? All right, so I want to start off kind of with this part first, which is cut your losses quickly. Okay? And so I don't think, this is really too complicated. Okay? But one thing that I do want to bring to your attention is that a lot of times if you look at the trades that stopped out, they usually stop out pretty quickly, trades that aren't going to work. So we know that when you enter the trade is kind of when it's at its most vulnerable, right? Maybe it's doing something significant, right? And whether or not there's going to be follow through, usually you get the answer relatively quickly. So in this case, we have a little bit of a breakout here. This red bar got negated, so it looks higher. Okay, so This is breaking above. It's also a 5-minute buy setup. This is on the 2-minute, okay? So it is breaking out here, and here's where your stop. On all of these charts, the red line is going to be your stop, all the examples that we look at, okay? So let's say you play this, right? And it tells you relatively quickly that this isn't going to follow through. I guess the high's been made. Maybe it moved too much in the morning. Maybe it got to resistance, right? In this case. Okay, so it's not going to follow through. Okay, so hesitate. Don't hesitate. Exit your stop. Exit your trade. If it sets up again, you can replay it, right? But you don't need to kind of sit there, hope that it comes back, all right? And what happens is a lot of people, right, if they don't want to exit and then it starts to not go and it doesn't look like it's going to work, they sit there and they wait for break even. They feel like if they can just get break even, hopefully, this doesn't sound like you, but if you're just thinking, if I can just get break even, that's fine. I'll be happy with that. I'm going to maybe leave an order there to get out at break even, right? And then I'll be happy with that. And then you never see it, right? And all that time, maybe you're distracted looking at these moves up, hoping that they're the ones that get you to break even. You could be taking a different trade, going after something else, right? This trade has already failed. The base has already been broken. Okay, move on, right? The uptrend is also over now for this stock, all right? So that kind of hoping for break even, right? Not exiting when you're supposed to becomes a huge waste of time, right? At the very least, at the very worst, it becomes a disaster, okay? And now I have worked with someone who had a really hard time trying to get them to break this habit, right? A lot of times their day trades wouldn't work and they would go look at the other daily, weekly, monthly charts and try to find a reason that it should be a swing trade, okay? Don't do that. If the trade doesn't work as a day trade, okay, don't hold it overnight. All right, see, imagine, right, being in this the next day. This is the same thing. This is where you entered this red line. Again, what is your stop, right? Take that first loss, right? If it stops out, then just exit, okay? Right? So if you have to replay it, you can replay it. Don't waste the whole day watching this thing and don't open yourself up for these big disasters. Okay, so cut your losses quickly, okay? If it tells you you're going to be out, don't hesitate. If the pattern fails, then you're out, okay? So that's what it means for me. All right, there could be other ways, you could apply this. That if your entry immediately doesn't get followed through, maybe you look to kill it even before it takes out your stop. Okay? So what I'm getting into here are kind of how these two things can still be true for me specifically. Okay? And that's, I think, the important thing about finding why these things can be true, because maybe in a broad general sense, they seem like contradictions, but when you get specific, then they actually can make sense and still coexist, okay? So that was the first thing. Cut your losses quickly. If it's not going to work, all right, proves to you it's not going to work, just be out, okay? Don't need to hope and pray, or, even be greedy in the other sense that you're thinking, well, I just have to be right. I just have to make money on it, right? I think that also sometimes motivates people to stay in a losing trade thinking, well, eventually it'll work. I don't want to take this loss. It's an unrealized loss. I'm going to wait till I actually have gains to realize, right? But what also I think this is referencing more often is that we have a play that's working really well, and we know that we can always give the play back. All right? We know that the profits that we have, as long as they're unrealized, could always turn into nothing or even turn into a loss, right? So that's the saying. Right? You can play things long, you can play things short. It's when we get too greedy, right, that we might run into trouble. Okay? So protect profits when they're made available. All right? So you get an entry, right? You can take some here. Maybe you take half, maybe you take a quarter, maybe you take a third, right? When the profits are made available, you can take some. You don't have to take the whole thing all at once, right? Especially now that we don't pay like commissions. Generally, retail traders, we don't pay now that the structures have been changed, right? Take a portion of the trade. You don't have to take it all at once, right? But when the profits are made available, take them, right? You can see here, right? This had a very nice uptrend all morning. Eventually got to lunch and decided I'm going to come in. So it gave the whole thing back, right? And so when this kind of thing happens, of course, and you're intending to hold it all day, or, it wasn't up enough, you're thinking, I was too greedy. Came all the way back in, and I gave the whole play back. Okay? When the profits are made, when they're on the table, all right, go ahead and protect some. All right? Because there's always that possibility, right? So that you take the play, you have some nice profits, right? And it's at a target, you want to protect them. Okay? Pretty self-explanatory, pretty simple. Protect profits when they're available. Usually for most of us, that's pretty natural. We know that it's unrealized, and so we want to get out, okay? So we want to take it. But I think more often than not, what trips us up is the getting out too soon, or not giving it a chance to work itself out, okay? Or to kind of go all day if it chooses to, okay? So on something like this, right, really, you get a chance to get out here. You could have taken some here, right in there. If you took this with me, this was the NIO last week, I did say this is not up that much. If it's going to fail, it's going to fail, right? And I left the red line on all these charts because all these were plays from last week, okay? And they always have a stop, okay? Now, this one, right, we finally got to target and then we closed it at the end of the day, okay? So let it work itself out, okay? Let it run. Right now, right, we took some here and then we took the rest half. Why did we take some at the first kind of point where it got to target, not the whole thing? Just in case it keeps going. Did it end up continuing to go? Not really. Ended up, the second exit was about the same as the first exit. But I want to give it a chance to keep going if it does, right? And so here again, right, on the AVYA from Friday, nice 5-minute buy setup here. Again, stop is here. Even though, right, it never becomes relevant, all the trades are treated the same, right? You have chances to get out here and here, even though this actually closes at the very high, okay? So what I'm saying here is for each of these trades, you can trade them the same and still have it be true that you're letting the winners run without being too greedy. Okay, and you're cutting your losses quickly when that becomes relevant. Okay, so as this runs up, you have some profit, fine, take a quarter, okay, or take half. Again, makes a new high, protects some more, right, runs up. I think at this point, like this trade would have been up 3 Rs, right, 3 times what you risked. Go ahead and take another piece, right? So the goal on this, when I say let your winners run, is not to, I'm going to get out everything at the highs because I'm going to know the highs. At the time that this is making new highs here and new highs here, you don't know that that's going to be the high of the day, right? Just like on this one, we didn't know, although it did end up being the high of the day, right? I still treated it as it could be, so let's protect some profit. All right. And then if it closes at the highs, all the better. Okay. So you can see on these other examples we looked at, right now you may be kind of seeing how these charts are all treated the same. They're all pretty much managed the same. We get to a target, you protect some. You can trail, use a 1 minute, a 2 minute, whatever you think is relevant there, take some profit as it's at the target because they can always come back in. So on something like this that comes all the way back down, maybe on a third or that last quarter, you don't make anything on it, right? Ends up you give all of that back, right? But that's going to be made up typically by stuff that ends up moving like this, right? Okay, so it's possible for these two things that seem face value contradictions to actually be reconciled to be true. Okay, so what did we go over? First of all, right, cut your losses quickly. If the play's not going to work, it's going to take out the stop, or immediately shows you at the point of entry that it's not going to get follow through, right? Okay, cut it. Don't let your losers erase multiple winners, right? That's the kind of thing that we want to avoid, all right? That's really, for me, that's what that's about, okay? and then utilize a management style that trails when profit is available. Okay, when it gets to the target, whether you trail 1 minute, 2 minute, or you just offer out, you take half of the play when it's at the target. When the profits are there, then you want to protect. Okay, that part, like I said, that's pretty natural. I think we all kind of get excited when the profits are there, know that they could be given back, and then allow a portion of the trade to be held longer, or what I call runners. Okay, so you got a play working really well, you got half of it protected, let the other half run. Okay, if the play ends up, the trend ends, comes back in, okay, fine. Maybe a third, a quarter, some part of it didn't make money. Maybe even that portion lost a little bit. Okay, but you allowed for it to show you if it wanted to give you more profit. Okay, so these two things, which seem like direct contradictions, actually can be made so that they make sense, that we can actually have these both be part of our trading philosophy. Okay, that when the profits are there, we protect some of the play, but at the same time, we're allowing a portion of it to go as far as it wants to go. All right, so that's one that I think you just take them at face value, can seem like direct contradictions, but if we're specific enough, right, we can actually make it so that they can be reconciled. All right, so there is a link in the description. Check it out if you're interested. If you're looking to turn around your trading, maybe there are just a couple things that need to be patched up. This is meant to kind of address the different issues that I've seen from the traders that I've worked with in coaching. All right, so check out the link in the description, and hopefully you saw here kind of a management style, right, that is able to apply both sayings, both kind of philosophies about trade management. All right, so hopefully you enjoyed that. I do think I would like to do more of these because there's a lot of things that kind of get repeated and I think are oversimplifications and really need a deeper dive to better understand them. And I think that can help kind of reduce some of the confusion. I think especially in hindsight, traders will beat themselves up, use this saying or that saying, because in hindsight, that one seems relevant, but I was thinking the other one at the time, right? So I think this will be just kind of the first part of this series. So hopefully you enjoyed it, and best of luck in your trading in the coming weeks.